You hear it everywhere. Grant Cardone owns $5 billion in real estate. He's loud, confident. He throws around words like billionaire and empire like they're facts. But here's what's worth knowing. The buildings are real. The empire? It's built on marketing. You're not just looking at a real estate mogul. You're looking at someone who mastered the art of perception. And the trick? It's not just buying apartments. It's making you believe he owns all of them. Back in 2012, Grant Cardone launched Cardone Capital. His pitch? Simple. Let the average person invest in large-scale real estate deals. No banks, no Wall Street, just you and Grant. Fast forward a decade and the numbers sound impressive. Cardone Capital reports managing over $5 billion in real estate across 43 properties. At a glance, it sounds like he owns it all, but when you look closer, filings show he typically owns just 1 to 5% of each fund. That's not empire building. That's what you'd call fractional branding. Grant Cardone didn't build his real estate empire with his own money. He built it with yours. Since 2016, Cardone Capital has raised over $1.5 billion from the public using Regulation A+, a U.S. law that allows non-accredited investors to put money into private offerings. It opened the doors for everyday people to invest in institutional-level apartment complexes. And Grant ran through those doors with a megaphone. You didn't need to be a millionaire. You just needed to believe in 10x. Cardone leveraged his massive online following, millions of fans across YouTube, Instagram, and TikTok, to market these real estate funds directly to the public. And it worked. Today, the firm reports over 18,000 investors. Here's how the structure works. You put in your money, Cardone Capital pools it together, adds interest-only debt, and buys multifamily properties. Then, Grant and his company collect management fees, acquisition fees, and take up to 20% of the profits through a structure known as carried interest. It's a clever setup. Grant profits up front, even if the property takes years to turn a return, and investors carry most of the financial risk. At one point, Cardone's marketing materials projected 15% annual returns. But in 2018, the SEC sent a warning letter stating that those kinds of claims lacked proper context and disclosure. He removed the numbers from official filings after the agency flagged them. So what are investors actually earning? Monthly return of about $56. That's not exactly mailbox money, that's gas money. Now, none of this is illegal. It's just structured for asymmetric reward. Cardone doesn't have to wait on rent checks. He's already collected his cut, and that's why this model works so well for him. Because it's built less on real estate and more on raising capital at scale. You've heard it in podcasts, seen it in ads, and watched him shout it from stages. Grant Cardone owns $5 billion in real estate. It sounds impressive, and technically, the number isn't made up. Cardone Capital does manage a portfolio valued at over $5 billion, spread across 43 multifamily properties. But here's the catch. That figure refers to the total value of the assets under management, not Grant's personal ownership. When you look at Cardone's equity in these deals, the picture changes. According to SEC filings and offering circulars, Cardone personally holds around 1 to 5% equity in each fund. The rest? That belongs to the investors. So when people say, he owns $5 billion in real estate, it's like someone taking credit for a whole wedding because they chipped in for the cake. Even his reported net worth has wide gaps. Cardone has publicly claimed he's worth $1.3 billion. But Forbes, after reviewing his public filings, estimated a more modest figure of around $300 million. Both numbers are cited, but the spread between them shows how murky these claims can be. And yet, mainstream media often repeats the billionaire line without clarification. Shows on Fox Business and others have introduced him as a billionaire CEO, reinforcing the narrative. The confusion lies in how Grant presents ownership. He markets the full portfolio number as if it reflects personal wealth. But there's a major legal distinction between managing an asset and actually owning it. It's like saying your name is on the deed, when really, it's on the brochure. To be clear, there's no law against promoting assets under management. It's common in finance. But for investors, there's a line between confidence and misinterpretation. Because when people hear $5 billion, they assume personal empire, not fractional participation. And that's where Cardone's real genius lies, turning minority ownership into a majority narrative. From the outside, Cardone Capital looks like a real estate powerhouse. Big deals, luxury properties, clean branding. But under the surface, it's a structure built on heavy debt, high investor expectations, and a level of risk that isn't always obvious. Take the 2021 Florida acquisition, for example. Cardone Capital made headlines for purchasing 4 apartment complexes for $744 million. The largest multifamily deal in the state that year. It sounded massive, and it was. But the funding behind it, not as flashy. According to offering documents and industry coverage, the deal relied on interest-only loans, leverage, and capital raised from everyday investors under Regulation A+. That means monthly cash flows were heavily committed to debt service. If rents drop, occupancy slips, or interest rates rise, the margins tighten fast. Then came 2024, and Cardone launched a new product, the 10X Space Coast Bitcoin Fund, a hybrid of luxury apartments and crypto assets. It combines real estate exposure with Bitcoin volatility. That mix might attract hype, but it also introduces layers of risk that traditional funds avoid. Now add Cardone's public behavior to the equation. In March 2020, at the start of the pandemic, he filmed a video announcing he was going bankrupt. Quote, the clip alarmed his audience and some investors, until he later said it was a joke meant to grab views. Legally, there's no regulation against viral marketing. But for investors in a private fund, that kind of messaging can blur trust and transparency. Then there's the legal history. In 2020, a class action lawsuit was filed claiming Cardone made misleading promises about projected returns and debt backing. The case was initially dismissed, but in 2025, it was revived by a U.S. appeals court, reopening questions about how returns and risks were communicated. Important note, no ruling of wrongdoing has been made as of mid-2025, but this highlights a pattern: strong marketing, ambitious deals, and just enough ambiguity to raise eyebrows. Because while the buildings might be real, it's the clarity that's sometimes missing. Let's drop the illusion for a moment. Grant Cardone's most valuable asset isn't in any real estate portfolio. It's himself, his brand, his face, his voice yelling 10X across social media. That's what fuels the engine. Cardone has built a massive online following, more than 10 million across platforms. And while most real estate investors focus on cash flow or cap rates, Grant focuses on attention. Because attention, when packaged right, turns into revenue. Here's how it works. He hosts 10X growth conferences. Tickets can cost hundreds to thousands of dollars, depending on the seating tier. These events aren't just about learning, they're about believing. And once you believe, you're more likely to buy books, courses, coaching, and yes, investment pitches. In fact, according to Business Insider, One event alone reportedly raised $45 million from attendees for Cardone Capital funds. To be clear, there's nothing illegal about that. Regulation A+ allows him to solicit non-accredited investors as long as proper disclosures are made. But what you're buying isn't always clear. Most investors assume they're getting a stake in Cardone's empire. In reality, they're often getting a small share in a single rental property through a pooled fund structure. Meanwhile, a private jet, the mansion, the Lamborghini, they're part of the performance. And even if the real estate underperforms, the Cardone brand still makes money. Events, views, licensing, and upsells don't depend on rent collection. It's what some marketing experts call a guru brand, a self-sustaining persona that sells success itself. That doesn't mean it's fake. It just means the persona may generate more income than the property ever will. So when you invest, you're not just backing bricks and mortar. You're buying into a story, and Grant is the narrator. In the end, that story is compelling, but it's not always clear where the storytelling ends and the equity begins. Let's be clear. Grant Cardone is a sharp operator. He knows how to raise capital. He knows how to get attention. And he absolutely knows how to monetize his name. But is he a real estate genius? Not exactly. He's a perception genius. He turned a small equity stake into global recognition. He made marketing louder than math. He built an empire not just from assets, but from image and influence. So if you're thinking of following in his footsteps, ask yourself this. Do you want to own buildings? Or do you want to own the camera? Because in this story, the money isn't just in apartments. It's in belief. The buildings are real. The empire is perception. If this helped you see through the hype, share it. Someone you know might be investing in the illusion.